Near the highs of the day. Time now for the closing countdown. Let's trade the close. Herb Morgan, Senior Managing Director, CIO at Efficient Market Advisors. Herb, what's driving the rally today?
Well, you got to rally because I think people are realizing a recession just isn't imminent. The data continues to come in good, and the excuses to call a recession just keep diminishing. And now here we are with more good data, and the market's rallying.
What about the end of the month coming up? Is that something you're watching closely? Do you think it'll make a difference?
No, I think the thing we're watching most closely is the three central bank meetings in September. The ECB, the Bank of Japan, and the Fed, all three are indicating they're going to continue to be easier and easier. Don't fight the Fed. I think, look, a year ago, the recession was coming because debt to GDP was too high at the corporate level. That's not happening. Now it's the slowing PMIs in Europe, the manufacturing PMIs. That's not happening. 2 weeks ago, it was the inverted yield curve. The yield curve is more inverted today, and the market's up almost 300 points. At some point, you have to accept that we're in a bull market, and it's likely to continue.
So do you expect the trends of August, namely the defensive trades working and everything else pretty much not, to reverse in September?
Yeah, I kind of see that. I think, look, a lot of people were on vacation. I mean, everybody was on vacation this month, and there wasn't a whole lot of volume. Again, it just comes down to, look, this inverted yield curve. We talked about this 2 weeks ago. The inverted yield curve is not being caused by the Fed raising short-term rates over and over to fight inflation and to stifle economic growth. It's just the opposite. They're about to get more accommodative. We can't take these idiosyncratic signals and then make these conclusions about recession. Even Brexit today, it looks like we're getting a hard Brexit. The pound's off a little, but the overall UK market's holding up.
If we do get central bank easing as you expect in September, is there a risk that the dollar strengthens and that could derail U.S. equities?
I think the dollar is pretty overvalued. There always is that risk that it continues to strengthen on that cut, but it's about the relative level of that easing. And I'm guessing we're going to get a little bit more robust easiness out of the ECB and continued robust out of the Bank of Japan. If we get a quarter point out of the Fed, it's all about the relative rates. Remember, the rising dollar, sure, it has a little bit of a negative impact on exports, but it's a sign of a really strong economy as well. And relative interest rates, with the dollar keep going up, that's another indicator that we're not likely to experience a recession in the beginning of 2020 like many are suggesting.